This is a review for Chapter 2. So again, we'll look at these review questions. I'm not going to do them all, but we'll go through some of the more relevant ones. So some of the the first one asks, what are the major characteristics of the organization and the conduct of CPA firms that permit them to fulfill their social function competently and independently? So that's kind of referring back to the fact that if you go back to that table where we've got our big four and our national and regional CPA firms, they all hire people that are competent. So by competent, we mean they actually have a degree in accounting. They have sat and probably passed the CPA exam. Again, they give them a period of time to pass that exam, so maybe not all at once, but over the period of 2 years, they should be able to sit and pass that CPA exam. Then they'll continue on in their education to take the continuing education credits, the CPEs, every year so that they can stay current. And then they also try to keep like CPAs in those firms that are related to the industry that they specialize in. So maybe they specialize in the manufacturing industry or medical services, or retail, or whatever else kind of unique industries could be out there, IT or whatever. So they try to keep people in those functions so that they can draw on their experience and make some educated decisions, as well as to be able to exercise professional skepticism. And then independence is very, very important. So as we talk about all these audits, we want the auditors to be independent of the client. So then that means that they do not have like any financial interest in that company. They don't have any relatives that are working for them. Again, there's no personal interest that they would have in making sure that that company that they are auditing ends up getting an unmodified or a clean report. So we definitely want to make sure they're independent. Then the next two questions ask about the PCAOB, which is the Public Company Accounting Oversight Board, and then the SEC, which is the Securities Exchange Commission. So the PCAOB oversees, it was created in the Sarbanes-Oxley Act, and it oversees all large publicly traded companies. So it oversees the audit of all of those large publicly traded companies. And the SEC was designed to have all publicly traded companies report to them. So like if there's a new filing, they have to report that. If there's any significant changes, if they have to submit their quarterly numbers, their annual numbers, all to the SEC. And then the SEC obviously would want them to be audited, which again circles back to that Public Company Accounting Oversight Board that's going to oversee the audit. So the ultimate goal of those two organizations is so that investors like you and I, who want to invest our hard-earned money in the stock market, can look at financial statements and feel comfortable that those financial statements are accurate and free from material misstatement, and we can go ahead and use those to invest so that there's no accounting fraud or financial fraud. And again, nothing's ever completely guaranteed, but you could feel confident using those financial statements to make your investment decision. Then it asks, if we go down a little ways to number 5, who is responsible for establishing the audit standards? So the PCAOB is who is responsible for issuing the standards for all of the large public company audits. And then the AICPA is responsible for doing the private audits. So they set those auditing standards for any entities that other than publicly traded companies. The AICPA does. So the PCAOB is focused more on the big publicly traded companies. Okay, then let's see. So let's jump down then to our where it talks about the quality control. So that is objective 8. So again, quality control is the standards and the practices that are within the accounting and the auditing environment. So there's a nice table in our textbook that talks about the different elements of quality control. But we've got leadership qualities like the tone at the top, and the corporate culture within these audit firms is very, very strong. So we want that, though, to be an ethical tone. So we're encouraging the best and the brightest to come and work and to do quality work and to try for advancement. And then again, we advance only the most capable and competent workers that are there. So you want that type of a culture that is ethical and encouraging people to do their best and to be their best. We also want them to have policies and procedures that provide assurance that the auditors are independent of any of the clients and that they are maintaining that independence. There's policies and procedures on whether to accept or continue client relationships for the specific engagement. And then the next one is human resources, where you are managing those engagements to say who's going to be on that particular audit. So who's going to be the audit manager, the audit, the staff level auditors, and the partner in charge of those. And again, we always try to evaluate those based on people's experience and competence levels, so we can have the right auditors on the right engagement. Then there's policies and procedures that actually oversee the engagement itself. So to verify that, that they're performing all the proper procedures for that audit, that they're gathering sufficient evidence, and that the auditors are available to consult with the clients and all of that type of stuff. Then monitoring is the last one, where there's a monitoring process that would provide reasonable assurance that these policies and procedures are relevant and accurate and that they are operating effectively. And then again, like I talked about in the textbook, the audit firms do get reviewed by their peers or by the PCAOB to verify that they are meeting up to all of those expectations, which is what question 12 talks about with that peer review. So just making sure that everybody is doing what they are supposed to be doing. Okay, so I think that is probably pretty good on those review questions. There was one case. Let's see if I can get there quickly. Too far. So I thought that this was an interesting one. I'm not going to quite go through exactly what it tells us to do, but as we read this case, Ray is the owner of a small company, and he has asked Holmes, a CPA, to conduct an audit of the company's records. Ray told Holmes that an audit was to be completed in time to submit his audited financial statements to the bank as part of the loan application, and then Holmes accepted the engagement immediately, agreed to provide that report within 3 weeks, and then Ray agreed to pay Holmes a fixed fee plus a bonus if the loan was granted. Holmes then hires 2 accounting students to conduct the audit. He spent several hours telling them exactly what to do. He told them not to spend any time reviewing internal controls, but just focus on the mathematical accuracy, summarize the data in the accounting records that supported the financial statements. So the students then follow his instructions, and after 2 weeks, they give him financial statements, which do not include any footnotes. Holmes reviews the statements and then gives them an unmodified auditor's report, which we're going to talk about that in chapter 3. But the unmodified auditor's report is the clean report. It's the best one. It says that, hey, we believe these financial statements are free from material misstatement and that they follow GAAP. The report did not refer to generally accepted accounting principles or to the consistent application of such principles. So again, we're kind of jumping a little bit ahead, but in an unmodified report, that should actually be the words that are said, is that the financial statements are free from material misstatement and that they are in compliance with generally accepted accounting principles. So he doesn't mention that. Then as we look at kind of what he did, I mean, he really took no time to figure out, is he qualified to take this job? Did he hire students that had any experience in this industry or any experience with an audit to understand? And again, that goes back to like having that professional skepticism. So we want to be able to look at these things and think, do these, it's not just about number crunching, but kind of analyze it and say, hey, does this seem reasonable? Does everything seem, on the up and up? Well, I don't think those students had the ability to do that. And then he really doesn't even sound like he did much reviewing of it. So, when you're thinking about those policies that we just kind of talked about, like the tone at the top and setting these policies and having competent workers, he's kind of missing the mark on all of those. And then the other thing is up at the top, to receive a bonus if the loan is granted. So then he's going to kind of makes him almost lack independence a little bit. He's going to get a financial kickback if the loan gets approved, and the only way the loan's going to get approved is if he issues an unmodified report. So you really, as an accountant, you shouldn't get any type of bonus based on the results. You need to maintain that independence. So again, there was just a lot of things that kind of jumped out in that one that you thought, oh, I don't know, none of this stuff seems like it's really quite managed very well and doesn't seem very ethical. So I thought that was a good one. All right, so that is it for chapter 2.